All right, guys, welcome to the BRAG group, the Black Real Estate Alliance group. We've been around for 2 years plus now. I created this group because I wanted to create a community of Black real estate investors and entrepreneurs. Simply because I felt like it did not exist. And so here we are, and it's been a really good run. We're doing monthly meetings. Prior to the COVID outbreak, we were also doing social events, and the purpose of the social events is because I think it is important to get to know people before you do business with them. Get to know their personalities, get to know what kind of person that they are. And kind of too often I've seen, especially amongst our people, it's this immediate kind of jumping into business with people that you don't know. So I felt that that those social events, it's a good time to have some fun, but also to just kind of see who you mesh with and who you may do business with in the future. As you may know, we have a Facebook group. We are working on some other mediums outside of Facebook that hopefully we will have up and running soon. And the main purpose, I feel, of the members of the group is to bring value to the other members, right? It is just not a resource center, even though there's obviously resources here. But we want to help each other get better, and by bringing value, I think that's what you do. And in my own personal experience, by bringing value to other people, you will bring value to yourself and to your business. It doesn't always have to be a pitch fest. So I'm just going to just quickly, because I've known Pedro a while, I love to tell this story because anybody has ever heard me speak, you hear me talk about the power of networking and what that means. I just want to tell you guys a really quick story, and then we can get started with the meeting. I met Pedro, I don't know, it might have been 7-8 years ago. I was still working at SEPTA. One of my buddies had a buddy that was putting on this Daymond John event. And for those who may not know, Daymond John is the founder of Fubu. He's on Shark Tank. Pretty much everybody knows the guy. And so interestingly, he was having this event. It was a sit-down dinner event. It was $1,000 a plate. And this is when I was still working at SEPTA, and I was like, oh, $1,000. That's my check for the week, right? And so that was my thought process. And then I got to thinking a little bit further about it. I said, $1,000 a plate. I said, well, you can afford $1,000 a plate. I said, these are probably people that I want to be around. At this time, my business was really still at the real early stages. So I wasn't using private money, but you always have to be, you have to think ahead of where you are currently. You can't just be in that present space. So anyway, I decided to go. I actually got the hookup, and my plate was only $500. Interestingly enough, and this is no knock at Daymond John. There was literally nothing to learn. Daymond John gave a little hype up speech, rah, you can do it, and kind of out the door. And so there was a lot of cool people there. There were, I don't know, politicians and judges and lawyers and whatever. I met Pedro, and I think that you connect with people. That's when I tell people you have to network with a purpose. I don't believe in going to places just kind of handing out cards. Hi, I'm Daniel. Hi, I'm Daniel. Hi, I'm Daniel, and you don't connect with people. So him and I, we just really meshed. And so interestingly, he actually put me in contact with this other group after that, because again, we both realized that we could do a lot more, and we just had similar ideas of how to grow a business. And so he put me into this Black men's business group. And in that Black men's business group, again, there was a lot of good people there. I was the only real estate guy. And so from that group, I met someone else who put me in contact with some other guys. And those guys end up being sort of private investors, partners to the tune of millions now in my business. So you never know, right? I could have taken the mindset of $500 a plate. I could spend $500 or it was really $1,000. But you have to put yourself out there. You have to network, and you never know who you're going to meet that's going to change the whole course of your business and create real relationships. Like him and I have a real relationship. It's not just surface level. So I just wanted to put that out there. Is that number one? He's a great, really, really smart guy. But also, when you guys you have to keep networking, because you never know what is going to come out of that. So that's my spill on that. I'm going to turn it over to Ebony. Ebony's going to go over the brag values, and then Pedro can get started. We can't hear you, Ebony. I can't hear you. All right. Well, I'll go over the brag values. Hold on. I think you're joining now. There you go.
Can you hear me now? Can you hear me? Now it's a.
You gotta mute your mobile. I think you have a mobile phone and something else. You gotta mute one of those devices.
Yeah, can you hear me now?
Yes, much better.
Okay, thank you. I had the mobile. I was connected.
Oh my God! Finally.
All right. So as Dan mentioned, we do have 9 brag core values, and I'll go through each of them. So the first one is community, creating a comfortable environment for Black investors. Number 2 is cooperation, selflessly helping others to achieve their goals. Number 3 is group economics, uniting forces to go after larger deals. Number 4 is mentorship, guiding the newer investors into the business. Number 5 is giving back, volunteering our time to help the next generation of investors achieve wealth. Number 6 is empowerment, uplifting each other. Number 7 is integrity, conducting business in an honest and ethical manner. Number 8 is knowledge. Knowledge is infinite. We want more of it. We chase it and we share it. And number 9, being social. We seek out connections, start conversations, and build relationships and partnerships. So I will introduce our speaker, Mr. Pedro. Oh, somebody say something? Mr. Pedro Moore is currently the CEO and founder of Funding Fuel Incorporated, which is an investment service that allows anyone to own multiple franchises for as low as $500 investment. He was the winner of the 2018 Black Enterprise Tech Connex Pitch Competition, and also Pedro serves as the venture advisor to investor Damon John of the ABC Hits TV show Shark Tank from season 2 to the present. Moore advises John on venture capital, due diligence, deal structure for his various deals from Shark Tank. Pedro is also the owner of Bump and Play, Delaware's first bubble soccer company, a uniquely modified version of soccer with a fun-filled twist. The company has been featured in publications including the News Journal, Delaware Business Today, and Middletown Transcript, among other publications. He is the former executive director of Delaware Innovation Fund and Investment Associate of Investment Associate of Innovation Ventures LP. Both are venture capital funds focused on growth and early stage investments in the areas of information technology, software, and business information services related to legal and financial services. In 2010, he co-founded the CoinLoft, Delaware's first co-working space, with the goal of building a stronger, more inclusive business community for Delaware's small businesses. Pedro is a graduate of the University of Delaware with a Bachelor of Science in Business Administration with a focus on marketing and management. While a senior on campus, he founded the University of Delaware's Entrepreneurship Club, enabling students from all majors to learn about entrepreneurship. So without further ado, I will introduce our speaker of the hour, Mr. Pedro Moore. Welcome, Pedro.
Thank you so much, Ebony. Thank you. And I'm sorry, I probably should have cut that bio down even more because you didn't have to go through all that, but I appreciate that. One little note too, at the very end, you talked about the Entrepreneurship Club and how Dan talked about the power of networking. It's so true because that Entrepreneurship Club is a student club, right, at a university. So I made a little history by starting that club. My motive behind that was to connect different schools, right? Whether you're fashion, whether you're an engineer with business, come together, talk about business ideas, right? I always been interested in stocks, but I was always intrigued, is there a way to buy into a company before it goes public? At the time, I didn't know what venture capital was, but through that organization, through that student club, someone connected me to a venture capitalist, who then, after I graduated from college, who brought me onto his firm. And then also through that same relationship, we got connected to Damon John, where today, at first, Damon John, I was working with Damon John through the investment fund, but now Damon John is actually a client of my company. And so, but the point is that all that happened through a series of just connecting, adding value, building relationships. So I'm just echoing what Dan said, is that, I totally agree. Focus on building relationships. Sometimes you may not see any immediate impact from it, but it's a situation where it's more of a long-term plan where you never know where that relationship can lead you down. I always say that good relationships allow you to skip the line. Right, allows you to, because even for me as a venture capitalist, typically you have to go to an Ivy League school. You have to have a master. You have to have a master's. I don't have that. I just have an undergrad, and I didn't go to Ivy League school. So having strong relationships allow you to skip the line. But today I wanted to talk about why Black individuals should start considering buying businesses as a way to build wealth. My motive, I've always been doing with this part of, Dan was always focused on real estate. I was always focused on businesses, but we both think the same. And because of the recent events, which even though they always been happening, but things been really, really, sometimes you just get sick and tired, right? And I'm like, you know what? No one's going to really respect us until we start owning more stuff. And so with that being said, I started this one recent group called Black Acquisitions Entrepreneurs, basically similar motive to Bragg, but teach people how to actually buy companies, how to, even if it's not majority equity, but even if it's a small stake in a company, how to actually acquire business assets. And so similar to the Bragg group, with this group, I wanted to just help teach, expose a lot of individuals to another way to build wealth, which a lot of people don't really realize they can. I'll give you one good example. And also too, I believe that real estate investors, Dan kind of alluded to this earlier, will probably have an easier transition into buying businesses than probably someone else that has not invested in real estate, because a lot of the things that you guys are doing, it's the same principles applied in the business world, same exact principles. The only thing is there's maybe just some few particulars that might be different, such as maybe valuing the asset and managing the asset. But for the most part, it's the same thing. So you guys are going to have a jump up compared to someone that has not invested in real estate or has not done any type of deals at all. So I'm gonna get started. I'm gonna share my screen. So again, I applaud you guys for expressing interest in going down this road with me. So a lot of these numbers you guys probably already know, probably already heard, right? The current state of Black wealth. You know, they're projecting our wealth to hit zero, our median wealth hit zero by 2053. And actually, I'm going to stop on that real quick. And that's another reason why I believe that buying businesses is probably going to be the fastest way and the quickest way for us to, well, I'm going to step back for a second. A lot of programs out there to help Blacks, because a lot of people are trying to solve this problem of us Black community hitting zero. A lot, you know, they want to give us preach about entrepreneurship, home ownership, invest in the stock market, you know, among other things. All those things are great, don't get me wrong, but a lot of those things provide moderate increases, right? For me, I kind of like to go for the gusto, see how far we can get, you know, in terms of achieving high goals. I don't want to just moderately increase our wealth. I want to be able to either equally match our counterparts, if you know what I mean, if not exceed them. Home ownership, when I say home ownership, not necessarily investing in property like what you guys are doing. I'm just talking about general home ownership. That helps, but it won't help get to that goal fast enough. Even investing in the stock market helps, but most billionaires built their wealth in the private market before they went public. That's the misconception in society, that they always say invest in the stock market. Don't get me wrong, I invest in the stock market, and I definitely recommend everyone to do that. But as a way to really build wealth, they say that's one of the remedies to do that. But really what it is business equity, having ownership and equity in businesses, right? That is the fastest way to achieve wealth. It's the fastest way for increase of fastest way to actually close that gap. Because if you think about it, once you buy an asset, the wealth, the value of the asset is transferred to your name immediately. And I'm gonna break down some stats too. Dan kind of alluded to this earlier too about starting a business and the failure rates, et cetera, et cetera. But that's part of the motive, right? And regarding the trend of entrepreneurship in the Black community, entrepreneurship has definitely increased, which is great, because that's one thing that they preach to help close that wealth gap is entrepreneurship. But the downside, a lot of people don't realize, most of those businesses are self-employed businesses where there are no employees. The downside, if you ever read the book, actually, I think it was, yeah, there we go. I don't know if anyone have ever read The Cash Flow Quadrant by Rich Dad Poor Dad, Robert Kiyosaki. And basically talks about employee, self-employed, business owner, and investor. The goal is you start as an employee, you become self-employed by starting a business, you move over to become a business owner, and then you become an investor. And that's really broken down by tax percentages. But he's really saying anything on the right side is where wealth is created. Anything on the left side, basically you're trading time for money. And so that 95% of the small businesses, and I think there's about 2 million or so Black-owned businesses in America right now, but 95% of those are self-employed businesses. So that means majority of those businesses, it will be difficult for them to move up the ladder in terms of becoming wealthy, because they're constantly trading time for money. In the event something happens, you don't make money, right? And a lot of cases too, sometimes they're not even making enough money to even support themselves financially. Now, granted, don't get me wrong. Sometimes a business does start at the stage, but they grow into the business owner category. And the reason why I'm sharing that is that starting a business from the ground up is definitely helpful. We need some people to do that. But there is another path, which is, what if you guys become an entrepreneur by acquiring another business? And when I say another business that's already in this category of the business owner model, where now you just remove that owner, and replacing yourself. So there's already a working system in there with employees, customers. All you're doing is changing ownership. And basically you come in and you do your best to either grow it, sustain it, keep it moving, etc. And you just keep the engine going. And depending on how big this is, and this investor category, I kind of label that as a credit investor stage, because that allows you to be an investor in other businesses too, according to the SEC. But those are the sides that you want to play on, and that's the goal should be the goal for a lot of Black entrepreneurs. How to get to the right side of this quadrant. All right. These are the failure rates, right? And so for starting a small business, this is over a couple of years, of course, but the failure rate to starting a small business is about 70%. The world I come from, for venture-backed startups, that's around about 40%. Acquisitions, now this is, there's no hard number to say the failure rate of buying a company, but the way I kind of estimated this was the failure rate of SBA loans, and it's around 17%. So in other words, the risk in terms of starting a business, starting a business compared to buying a business is reduced if you actually acquire a company. And I remember, so again, I come from a venture world, and where we invest in early stage companies. And these companies are early on. Sometimes they may have 2 or 3 employees. They may have a little bit of revenue, but their goal is to scale, right? So the reason why these startups are considered risky as well is because most of these startups fail. And when we invest in a portfolio, let's just say a rule of thumb, 10 companies, we already know that majority, more than half, probably will fail. We won't get anything. We'll lose all our money. Maybe a quarter of it, we might break even. But our hope is that 10 to 20%, let's just say 1 or 2 companies are successful, where they return our entire fund. We get a return off of those 2. But majority of these startups actually do fail, even though they are venture backed. Majority of them do fail. And so even though there's a increase of a lot of people want to do that, the risk is a lot of them do fail. So again, going back to trying to close that wealth gap, if most of these businesses do fail, it's going to be harder for us to meet that goal of reducing that wealth gap by 2053. However, buying businesses might help us achieve that goal because these things are already operating. They have a lower failure rate. And one private equity investor, I don't know if you guys are familiar with that. Basically, that's the parent. Venture capital is like the child of the private equity world. Private equity, they buy and sell businesses all day long at a higher scale. I remember talking to one private equity investor, because me coming from the VC world, and I was telling him about how like most of our portfolio fails. And his exact words, well, that's different in our world. We don't analyze a deal with the assumption that any of them fail. Most of them really don't fail. It's a matter of how much of return will we receive, right? And that just give you a perspective. Private equity, because they deal with buying existing businesses, it's a question of how big of return we will receive compared to venture capital, which deals with startup companies. How many of our portfolio failed? And out of that, how many will succeed? All right. And some of these things you guys probably already know too. And the reason why this might be a great timing for us is because baby boomers are expected to retire. Some of them are already retiring now. You guys probably heard that stat too in the world of real estate. And the same thing applies to small business owners. A lot of small business owners don't know how to exit their company. All their wealth is tied up in this business. And it could be scenarios where their children don't want it, right? Some of them may take it, but some of them don't. You know, I know a gentleman had an insurance company, was worth millions. He wanted to give it to his kids. His kids didn't want to do it. And so he had to sell it. But the thing is, most of these business owners don't know where to go or how to really liquidate properly to officially retire. And if you can get ahead of those individuals, get in front of them, you may have an opportunity to buy these businesses in a creative way where it may not have to be a lot of cash out of your own pocket, right? But the good news is that a lot of baby boomers are retiring. So being ahead of that curve, it'll allow us to have more deal flow, more opportunities to get involved in. Especially if you think about now, even with COVID, you know, the profile for some of these individuals, they could be burnt out, right? Because depending on what type of business they are, COVID was probably scaring them, especially if they're 50s, 60s, they're already considering exiting, and then COVID hits, right? They're burnt out. I have a couple of deals right now. I got one deal right now. This one guy just emailed me. This is a simple business. This is a laundromat. And he just saying like, look, we made some investments. You know, I'm old. He even said it. He said, I'm old. I got some injury. I'm just tired, right? In the real estate world, those are buzzwords, right? You guys get the same stuff. Those are buzzwords for us. Okay, you want to exit. You have a good business now. You want to get out too. So these are all great opportunities for us to take advantage of. This is just confirming how fast wealth can be transferred. This is not necessarily an acquisition, but this just shows that soon as you sign on a dotted line, wealth is transferred. This is the young lady that's the CEO of In-N-Out Burger. She's a billionaire, but she's a billionaire because her grandfather. She turned 30. Her birthday gift was 50% of In-N-Out Burger. And I think when she got a little bit older, she obtained a little bit more equity ownership. So now I think she's a majority share owner in the business. But as a result of that, she became a billionaire, right? And that'd be awesome. With something that we can do for us. So how to really get started in this space. So I'm gonna start with owner operator versus owner investor. Now, this is more of your personal strategy going into this business. Owner operator, think about that cash flow quadrant where you are part of the left side, where you're self-employed. Think about the person that works day in and day out inside the business. Hence the reason why some of the owners may want to exit because they're tired, they're burnt out. They were most likely owner operators in that business. They're burnt out, they're stressed, and they want to exit, right? So my personal strategy, because I realize my gift is connections, building relationships, finding opportunities, structuring deals. That's my gift. I heard a quote the other day. I think somebody, John D. Rockefeller, said that if you work all day, you don't make money. That might be a little off, but something along that line where if you work all day, you don't make any money. In other words, what that's saying is that so for me, I'll give you an example. There was a Dan knows about this. We were, there was a existing franchise that we were trying to acquire. I negotiated a good deal, probably knocked off 65% of the asking price. The owner was the owner operator. She worked in there day in and day out. She had health problems, et cetera, et cetera. But I didn't want to. She was probably thinking I was going to come in and kind of replace her. That's not my strategy. I don't want to go in and have to do day in, day out, because that's not my best gift. I'm not that, I'm losing money if I'm going in there ringing up people. It was Auntie Anne's franchise. Ringing up a Twisted Pretzels. I'm losing money if I do that. My gift is going out, building wealth, finding opportunities, and structuring deals. And so while we were trying to work on that one deal, I already had 2 other stores. Because one thing they say about franchising, when you start to have economy of scale is when you have multiple stores. So we were close to closing that deal. I already started building relationships with an owner that owns 2 other stores in Pennsylvania, and I already knew the owner of a store in Delaware. And so the good part is they didn't have no broker. I was pretty much the only person that I really knew that had expressed interest in buying. And so, which kind of gave me the upper hand because there was no competition of others trying to buy it. And so my hope was we closed that deal. We closed the guy that owns the 2 stores in Pennsylvania. So that'll be 3 stores. And then we closed on the one in Delaware, which would have 4 stores. So my hope was to, within like a couple years, maybe 2 years, have eventually 4 stores, right? All within a, reasonable miles between each other. And, but of course, COVID hit, and Auntie Anne's is a foot traffic strategy model, not necessarily a takeout model. And so that business was heavily impacted. So we decided to like pull out because they closed stores. At the time they had 10 employees. Well, in the beginning they had 10 employees. By the time, or we revisit and asked how they were doing, they closed and they only had like 1 or 2 employees. And they were still trying to sell it to us, but like, no, that's not our investment strategy. Again, we wanted to be an owner investor, meaning that you have to stick to that too. Because we could have still took the deal, but that would have required us to physically be in the store to twist pretzels, ring up people, hire new people, be in there day in and day out. And again, I don't make money that way, right? And that was a small store anyway, so it wasn't even a high volume store. So it wasn't like we was going to be making like buku money off of that. And so realizing that, we pulled out. They were mad, but hey, business changed. So I personally recommend owner investor, because owner investor puts you in the category, the rich dad, poor dad, financial quadrant on the right side, the business owner, and possibly even the investor side. So that way you don't have to actually do a lot of the day-to-day work. Okay. So then after that, you got to figure out what industry. Me personally, I love any type, because I love business. I can go in any industry, even though if I don't know the details. My personal opinion is every industry works the same. There are some certain specifics that helps, but again, if you come in with the owner investor model with staff already in place, there's most likely a supervisor or maybe a VP that can be bumped up to CEO. Of that store that I'm referring to, there was a couple lead shift managers. I was going to bump them up to a store manager, right? They know the ins and outs of the details of the business. But some people might have a preference where, and sometimes, especially for your first deal, maybe it might be preferred that you stick with an industry that you're familiar with. So think about where you work, where you have a lot of experience in. Is it retail? Is it technology? Is it real estate? Is it construction? Is it I'm trying to think, security? I'm trying to think of other fields, mental health, healthcare, etc. Think about those industries that you have direct experience in, because you can also have a better conversation with that existing owner when it comes to selling the business. All right. So I would say that'd be a starting point. Think about the industries that you have, that you worked in, that you have a personal interest in, and you can begin there. And from there comes the sourcing deals. Now, sourcing deals is, again, for those that that's in for properties, it's the same process. You go out, it's marketing. You going out, finding deals, networking, letting people know that you have interest in buying companies in these particular industries. Sometimes it is just sending out letters, emails, contacting, being blunt and direct. The thing I was mentioning about laundromats is because I sent out a mass letter to a whole bunch of laundromats. Sometimes that's a hit and miss strategy, but sometimes it works. I have been receiving phone calls from various folks that have expressed interest of selling. Now, not everything is going to really work out. Some conversations really didn't go anywhere. Some people I didn't even call back because I didn't like their voicemail, and I didn't feel like, because I want to be creative with the deal structure. For example, some people just say, hey, we want cash, right? And I'm like, okay, but that's not realistic, especially in today's climate where a lot of banks are not really lending. Even though you're buying an existing business, they still view you. Banks don't get the concept of acquisitions. So banks still view you as a startup company, even though you're buying an existing cash flow, even it could be a profitable business, they will look at it and consider it, but they still put a lot of weight on you personally, meaning like personal guarantees, collateral, like all that stuff. And so I try to stay away from people that are going down that road. But sourcing deals, it is being aggressive, of letting people know, reaching out. And there's a lot of back end stuff too. There's a lot more details in terms of finding deals too. I won't get into those particulars. That's almost a session right there in itself, sourcing deals. But just generally speaking, it's of course obviously networking, being proactive in a sense of finding a database, finding companies that you think are interesting, and then going out to trying to reach out and contact the CEOs or the founders, owners of those businesses, and just trying to spark a conversation. Because that's the whole goal. Just start creating a conversation. And Dan mentioned earlier about rapport. That is very, very big, because if you think about it, these owners probably been working in this business for quite some time, right? 10, 15 years, right? And now they're going to just give their baby to you. And they're not going to just give that baby to you just willy-nilly, especially if you want to be creative with the deal structuring. So you have to take the time to build that rapport to make them feel that you're trustworthy. The one at the end deal, no, not that deal, but there was another deal with this one owner. I found out that the reason why they were wanting to sell is because his wife was sick, and I wanted to have a meeting, just to have an initial meeting, just to build rapport and conversation. And what I did just to impress them, I bought a get well card and I bought some flowers, right? And of course they weren't expecting that, but it gave me a leg up to build that rapport. Like, oh man, this guy is really, really something, right? And that's what's just really needed to give them confidence to have conversation. They can be more open to giving more details about the company, more flexible with you in terms of deal structuring. And the last part is seller remorse, right? Because as it gets closer to actually selling the business, there could be something that could arise where they start to have seller remorse, right? Because they own this business for quite some time. And you don't want that, because you don't want to go through all that work and all of a sudden for them to back out, right? And so that's why it's really, really good to do that. And identifying the motivated sellers, we kind of already know what that is, right? People that are trying to retire, have maybe a health issue, who are really just burnt out for whatever reason. And then after that, it is a little bit of a numbers game where you just got to keep consistently going at it to let people know this is what you're trying to do. Keep being proactive, trying to find deals and sourcing deals. You're gonna have to source a lot of different deals. And some of them there's a grocery store in here, a small corner grocery store that I was trying to get into. And I sent him an offer. He didn't really entertain it, and he kind of went a different direction. I don't think he's going to have any success with that direction. So I'm actually going to follow up probably another month or two to revisit that. So because he I don't know why he's going that direction. I don't think, I think it's actually a bad idea, but that's what they want to do. So, but I know he does want to get out because he has another job opportunity that's going to really demand a lot more of his time. And he wants to get this get this store out of his personal portfolio, so that way he can focus on his other opportunity. So with that being said, I ain't going to say I'm no accounting, all right? I'm not an accountant, but I do know how to review some financial statements. And so I'm not sure the knowledge base of those that are on the call. So I apologize if you're already well-versed in reading financial statements. I apologize. I'm going to just basically read it from, with the assumption that no one really knows, okay? And so there's going to, typically when you begin the due diligence process, there's a lot of things you want to look at, but initially, you want their income statement and a balance sheet, because for the balance sheet you want to see what kind of debt they have, what kind of assets they have. But how you value a company is a little bit of arts and science, as if in anything. And there's a couple ways you can really go about valuing a company. One, there's this concept called leverage buyout, where in that scenario, you kind of give, generally speaking, you kind of give them what they want in terms of the price, but you're creative of how you pay for it, right? And you're creative in a sense that maybe there's some owner debt. Maybe you help pay for their insurance or pay for the perks. Maybe there's a little bit of debt cash down, or you bring in some investors. You know, there's a lot of different ways. Or you could just, especially if you have the cash, you can negotiate I'm gonna just say the financing, not necessarily the cash, but the financing. If you have the financing, you can go in and negotiate a significant discount to be able to facilitate the transaction. But starting off with an income statement, you know, you have your
Pedro,
yes.
I just a quick question.
Sure.
How do you, and if you're going to get into this, that's fine. So this is all great because they hand you this income statement. How do you validate this stuff, all this information?
Yeah, great question. My personal strategy is trust but verify. And another way I say too, innocent until proven guilty. So I assume what they give me is accurate. Now, of course, you don't close no deal based off of that. But there's two ways you can do it. One, of course, you can always have an accountant or audit, but no one really wants to do that because that costs money. But one way to really validate the financials is their tax returns for the company, because they can't really lie on. I mean, they could, but they're more in trouble with the feds than me. So I use the tax returns as the real proof of how well the company is really performing. But off the bat, from what they give you, such as, you know, their P&L statement, I use that to just get the ball going. But part of the due diligence process, I don't have a checklist right now, but I have a checklist of a whole bunch of things that I asked for. And so some of the things include past at least 3 years of historical financials. So that includes the actual QuickBooks financials, but also that includes the tax returns for the past 3 years as well. So to make sure that's consistent with the actual financials that they provide you. And a lot of times it is give and take. There may be some small variations or whatever, but that sometimes happen. But if they're close, that kind of gives you confidence that everything that they're doing is correct. But tax returns will be used to really validate it without having to go for an auditor.
Can I just ask you a quick follow-up?
Sure.
So this is similar to me when you're investing in like a large multifamily property and they give you information that's just sort of just like this. And just like you're saying, what I do in the beginning, I'll just take it on face value that everything you're giving me is right, to put it under contract, and then you verify. Is that a similar process?
Yeah. Yes.
You put it under contract, and then you start to ask for all those additional documents.
Correct. Because you can create so typically, let's just say, let's just say that here's a deal, right? And you can create a value or offer based off of that. So you can send them a letter of intent. They call it a short for LOI for short, saying, hey, we want to buy your business off of this offer based off these financials, contingent upon we do proper due diligence, right? So due diligence, like you were saying, Dan, that's when we kind of look up under the hood. Actually, I do kind of allude to that right there, where you start performing some due diligence, and that's when you start doing the back checking. But initially, yes, you can use what they give you as the initial offer to begin that process, because you're believing this is also about trust too. So they're believing that you have the capabilities to buy the business and run the business. So you want to trust that what they're providing you is accurate as well. So it's like the beginning baby steps of building trust on both parties. But yeah, yes. And so something that you want to look at as you're reading through the financial statements. Well, I'm going to jump to really how do you begin to do an offer. This down here at the very bottom. So we see EBITDA, net income, profit, sellers, discretionary earnings, or just earnings. They're really all the same thing, especially when you're dealing with small businesses. That's basically the profit of the business and what's left over. And that's what you use to begin to value your business. Now, I also want to take a pause for a second. There's a lot of different ways to value businesses. Startup companies, venture-backed companies are not valued based off of that. This is just with the assumption that you're valuing a company, a traditional business. I'm gonna say that it's not venture-backed. It might be an HVAC company. It could be maybe a I don't know a maintenance company. Something simple. Type of business. This won't be a high scalable type of company. The same thing with a distressed company. That's probably going to be valued a little bit differently as well. But this is based off of most small businesses. In this, I'm gonna call it the 500 to probably $5 million revenue range, maybe even up to $10 million range. And part of the reason why that is the case, because once you start getting into the business are doing like 10 or more, you start getting in the field of private equity, and private equity trades at a higher multiple. So let me see. So this business right down here says 60 grand. So a private equity firm, they may trade at 10 times that, right? Where for a traditional business, you can see here, it's 1 to 5 times that earning. So 60 grand. 5 is basically saying it's really a growing company. It's a good company, and things are looking really good. And there's really nothing really wrong with the business. That's most likely you probably really never have a 5 multiple, but it can happen. But so in this sample, as a quick way to kind of value a company, assuming that all things being equal in terms of like things are going really, really well, the most I would say you will value it is 5 times their EBITDA, their net profit down there. So that's 60 grand. So 5 times 60, boom. That's like, I think that's like 300 grand, right? And that's one quick way to do it. But on average, it's going to be a multiple for a regular business, probably around a 3 range. So that's, what is that, like 180? Yeah, well, like 180 grand. So that's just an easy, quick way to kind of help you kind of quickly value, okay, how much is this possibly worth, right? And so using that range, and so that range, 1 is like, man, the company is not really doing well, sales been stagnant. Same thing with even 2. Sales been, it's profitable, but sales been stagnant, not growing. 3 is probably like, it's been growing maybe 5, maybe 10%, but probably around 5% annually in sales, even profitability has been growing around that. I would say that's probably a good ballpark for a valuation. But simply put, to make it easy for everybody, you look at the net profit and multiply it within a range of 1 to 5 times. That's a good way to value a company.
Hey, Pedro, excuse me.
Yes.
There's a couple of questions in the chat.
Oh,
I don't know if you
yes.
want to take those at the end or how you want to do it, but just so that you're aware.
Okay. Well. Let me see where they at. I'll see what they are, because I'll see if some of them I will address. Where's the chat?
Well, I can read them to you.
Oh, okay. All right.
So from Brian, he's asking, what would be a normal due diligence time frame before moving forward to the next phase of the purchase? And do you suggest getting an accountant to audit a company's numbers?
For this second for a auditing a company's numbers, if you have the money to do it, if you don't feel that you have expertise, like for me, I do this for a living. I read financials, so I feel comfortable in doing it myself. But if you don't feel comfortable, you can have an accountant to review the financials. To do an audit, for small businesses, I don't know if they're going to be willing to do an audit, because that requires a lot more time. that they may not be really, just to have some outside firm to come in and to do all that. So I think the best way in terms of audit to verify the numbers is having them the tax returns that they file. That's a good way to have I'm gonna call it a quick, easy audit for that. But in terms of evaluating the numbers, if you want to bring an accountant, that's fine. More on your end to help you review the numbers, that's fine. You can definitely do this. But a lot of these things you can learn on your own in time. And what's some more questions?
What would be a normal time for that due diligence period?
Oh,
For moving forward.
Yeah, that really depends on both parties. That can, I don't want to scare anybody, but due diligence, especially at larger firms like private equity firms, it could take the rule of thumb is like 400 hours in terms of man time of reading through. But sometimes it may not take that really long because these are smaller companies. But put it like this: the sellers, if they're expressing the sale, they are looking to sell. So the sooner you can get that done, I'm not suggesting rush, but if that means you got to take time to review everything, take your time. But at the same time, that means they might be shopping for other people too. But to answer the question, there's no hard time frame that this can take. It really depends on your speed of being able to review everything they have, doing reference checking for some customers, looking at a couple things, other things. So that really depends on both parties. Were there some other questions?
Carlos, did you have a question?
Yes, I do have a question. I'm not sure if it's a loaded question or not,
Okay.
but if it is, I guess you can answer it later. Great stuff, by the way. I just want to say great stuff.
Oh, thank you.
Yeah, man. So I'm looking at this, and I'm looking at the net profit there of 60,000. I'm like, okay, so that obviously has to go back into the business. Let's just say you were going to purchase this. Like, how does a serial acquisition person pay themselves from these kind of things? I don't know if you're getting into that or not.
Oh, yeah. Actually, I don't know if you know what? I can get into that because I think I was supposed to, but I forgot to upload it. But there's like a cheat sheet. I found this online. A cheat sheet. Maybe this might be it right here. So this is just a template, but and actually, you know what? As I'm doing that, I'm gonna pull up. This is the grocery store I was looking at. Where are thou? Where you at? Okay. So this is what they gave me at first, and I'm gonna go back to answering your question too about how do you make money from this, and that because actually that's the whole point of it all, right? That's the main question. And so this is what they gave me at first. And actually, I didn't get a lot of information from him in the beginning. I just was trying to just get the ball going. But of course, before any, we pull the trigger on anything, we're going to get tax returns, et cetera, et cetera, et cetera. So first things first, take what they have, assume everything is correct, right? Assuming everything is face value is correct, innocent until proven guilty. I believe that everything they sent me is accurate. Now, when they sent me this document, I think they did have a typo in here because this grocery store, I think was really here, which was actually in favor for me because this is their total income, 611 for last year, and so there's one step that you do want to do, which helps with negotiating too. We call like recasting the income statement, and all that really means because when you own business, one of the business benefits of owning a business is that you can buy stuff for yourself in it, right? You can buy a car, there's perks, vacation. If you're part of an association and the association has an event down in Florida, you pay for that, or there's a lot of different perks people pack into the business. But the reality is that's not the real cost associated with the business, right? And so first I realized when I was doing the numbers myself, I put in there all the revenues right here, but then I realized they had 611, but then when I put it in, it came out to 645 in terms of total income. I'm like, okay, cool. Maybe it was just typo or something like there, right? So fast forwarding down, this is just cost of goods. So things are still looking good, right? And so the nice part by it jumping up that much, the net profit, if you go back, the net profit from what they showed me at first was 80 grand. So initially, I think he wanted like 240 or something like that for this business. And so that's around the 2.5, 3 multiple of the EBITDA. But when I recasted the income statement, I'm like, oh, really? Assuming this was a typo, is 113, you know? So even nice. I'm like, okay, cool. So you selling your store for 240, around 200. So all things being equal, if I don't take any cash back or I don't reinvest back in the business, in theory, you can pay that balance off within a year. 2 years or so, in theory, right? And that's one way I look at it, right? If I just take the core cash that this business is generating, I wouldn't do this in practice, but in general, in theory, could I pay that balance off within a short period of time? Okay. So another thing too, you see this right here? I didn't get a chance to confirm this right here. So total automobile expense, right?
Hi, I'm sorry, Pedro.
Sure.
Forgive me for interrupting, but I don't know. The screen which which is showing right now is not referencing the numbers you're talking about.
Oh, are you guys able to see this?
I'm seeing
Excel
grocery
screen?
acquisition financing ROI risk profile. Is that what you wanted to see?
Oh man, I'm
Okay.
sorry. Thank you. So I'm trying to share. Oh man. So I have the Excel file up. So y'all probably looking at me like, what the heck is he talking about? Let me see if I can stop sharing this and share the Excel file. Let me see if this will work. Oh, nope. Here we go. Thank you for that. Okay, can you guys see this? This income statement now?
Yes.
Okay,
Yes.
okay. Now probably things become a little bit clear. Apologize for that. You're like, what is the brother talking about? Like, Dan, who did you bring here? So you can't see, you won't be able to see the other income statement that because I can only share one thing. But right here, he had $611,000 right here from the information he provided me. But when I tallied everything up, it totaled up to $645,000. So I'm like, okay, even better for me, right? So as I scroll down, I'm just looking at, this is their cost of goods for the grocery store, right? And then also, regarding the net profit, his business came out to 80 grand a year. It was 80 grand here because it was only 611 up here at first. But when I did a calculation, it may have been just a mishap on their end, a typo or something. It bumped it up to 113. So if it's 240, 113, in essence, again, you can pay that off within a good period of time, right? So anyway, but going back to adding back things to the income statement, meaning that there could be personal items in here that are not directly related to the business that you could basically take out, which can increase your profits, right? So using this as an example, and I didn't go into details for him with this, but right here, there's a car, right? That's about $4,000 almost, right? I didn't ask him, but so that's about a $300 monthly payment. So that's the average price for a car. So my assumption is that business could be paying for a car, okay? And so now, granted, it's a small amount in terms of the big picture, but in essence, you could remove that line item because when you buy the business, that car will go with them. You won't be paying for a car note anymore. You will add that down to this 113 and bump that up another $4,000. Okay. So that helps you show that, okay, there's even more profit there. Now I'll give you a tip for a negotiating tactic. This is a way to, sometimes it may work, sometimes not, but it's all about having tools, right? To negotiate deals where you may not have to put money out your own pocket. So let's just say if let's just say you agree to owner finance and you're able to get strike a deal where he'll do owner finance for the bulk of the deal, but he wants maybe he wants maybe some kind of down payment or something like that, right? Let's just say it's maybe 40 grand, okay? So let's just hypothetically, if asking price 240, you do 200 owner financing, but he wants 40 cash, right? And maybe you only have $20,000 in cash. But to close the deal, you can say like, look, I can give you 20 grand in cash, but I notice you have a car payment on here, right? What if, and part of the deal, get the other $20,000, what if the business continues to pay for your car payment for the next 4 years or 5 years, right? And so I'm rounding up. So that's 4,000 times 5, right? That's 20 grand. So you can negotiate a deal where say, okay, what do we go? So we got 200 grand owner financing. Here's $20,000 in cash. And what we'll do is we'll put in the contract that we will continue to pay for the car. And let's just say it does get paid off by year 5, whatever. The business will still pay for this car for the next 5 years, which that amounts to $20,000. So boom, you now have the full financing to close that deal. All right. Now this can be done. This is just with a car, but that could be done with anything. I didn't realize that tactic because I could have used that with the one story that we were trying to do. Is the lady had health issues. She wasn't pulling out a salary, but I noticed she was doing health insurance. So we could have negotiated a deal like, look, we'll pay for your health insurance. I know she did have a health issue. This is why it's really important to build rapport, because you want to get them to talk as much as possible. Because you basically, I know this is going to sound a little wrong, but you get to use all that information against them, right? So the lady with the health insurance, because we all know health insurance is expensive, right? Even getting it on your own is going to be expensive. So we could have negotiated a deal to even less money out of our pocket to say, look, we'll pay for your health insurance for the next couple of years. So that way you don't have to pay any, even though you're buying this business, but you don't have to, pump anything out of your own pocket, right? So anyway, that's one quick way to review to help get an idea of how to value a company. And again, and sometimes some of these owners may already have a price in mind. Again, it depends on your strategy. If you already have financing, you can negotiate a little bit better because you can say, well, look, based off of your past history, you haven't really been growing. So based off of these numbers, I probably want to only do it, 2 times the multiple. The only downside, if you do that, you might not be able to be that creative in terms of, I'm gonna say little to or no money down type of deals. You know what I'm saying? So it depends on how you want to attack the strategy. If you have the money, you can definitely be creative, right? And say like, this is what I want to pay because I got the backing. But if you don't have the full backing and you want to leverage them a little bit, you might have to give them what they want, right? In order to make the deal happen. All right. So now I'm gonna stop screening sharing this so we can go back to the screen of how do you make money from this? Because again, this is with the assumption that you will want to be an owner investor. So this is the reason why it's really good to know how well the company's doing in terms of profits, because that dictates, that's how you will get paid. Because you basically, if this is your strategy, you don't want to be the CEO or you don't want to be the store, I don't want to say store manager, but the general manager. You kind of just want to be the overseer. Depending on how big a business, you can always kind of put yourself with a salary in there. But in essence, there's this concept called management fees. That's where you're going to make a good chunk of your money. Sometimes you can close deals where you get a little bit something at the beginning, but using this as a way to make money. This is what I was doing with the grocery store. So this is with the assumption that 10% down. So let's just say they agreed to owner financing, 10% down, meaning that you got to bring 24 grand out of your own pocket to invest. This will be the debt service every year that you pay. All right. And this is with the assumption that they only profit about 80 grand a year. Okay. And this is with assumption 2 is 3 times EBITDA. So what you can do is say, you know what, I want to charge myself a management fee of I'm sorry, 20 grand, right? And so you got to keep that in mind. That still gives you enough wiggle room. I think maybe, so if let's just say I put 0. I'm gonna start with 0. All right, you can see that's just that's what's left over even after your management fee. So right now, because that includes this column right here, is what your new net profit will be. Okay, because it's including your debt service right here. All right, so it went from $80,000 to 50 grand because now you got to pay. You're paying him back over a period of time. Now this is based off a 10-year repayment period for this formula. But everything can be adjusted. So, but if you want to include a management fee, let's just say you put in 20 grand, all right? So that's what you take a home every year, right? However you do it, whether you pay yourself quarterly or annually, however you want to do it, but that's the total package. And that right there will be, oops, hit the wrong one. That right there, especially if you get invested 24 grand, that right there will be net profit, okay? And as you can see, how much did you invest out your own pocket? 24 grand. These are kind of ways to kind of help you visualize, okay, can I really make, all things being equal? This was the assumption, all things being equal, everything remains the same. That's one thing that when you do go in a deal, you want to buy based off of now, but of course you want to invest for the future. Invest for the future, but you buy off the now. And buying off the now is the assumption that all things being equal, if things remain the same, can you get a return on your investment if all things remain the same? So if every year your store generates a profit of 80 grand a year, you can still get your money back, okay, off that deal. So as you can see, by year 2, you already made your money back in theory for that business. I hope that helps. Does that help a little bit, Carlos?
It makes perfect sense. I was just curious because I've seen some of your stuff before, and I was just wondering. I'm like, well, I guess the name of the game would definitely be make a couple of acquisitions and then let the people do what they got to do, and then that way you take your fee out.
Yes, exactly. And of course, the bigger the deal is, the more money. That's the reason why they say that you want to go for. So there's a ballpark, and I'm pretty much done too, actually. The rest is I kind of already went over this, and these are just ways to negotiate. I already talked about some of these ways to get finances. A lot of these things you guys are already familiar with, but these are just ways to be creative of getting the deal done, right? You structure a deal, either seller financing. Bank loans are an option, but it's kind of hard to get those. Asset-based lenders are basically where if you have a business that have a lot of heavy assets like equipment, you can find a lender to kind of to give you money based off of that. So that's one way to, they have a concept of a capital pie or a capital stack, however you want to word it, as a way to kind of get to your number. But you can also use, another little tactic too, is sometimes you can give the owner equity in the business too. So you may not, you don't always have to buy 100%. You can buy maybe 80, and depending on how much that 80 is worth, that can go towards your down payment or cash in the business. So these are just knowing what tools you have to be flexible to help make a deal happen. Again, that goes back to listening in the beginning, because if you have a guy that's burnt out, but he knows that the business can grow, he still may want to be a part of, especially for if you do sell the business maybe a little bit longer after it grows even further. And this would be a good way for them to still at least get a little piece of the pie down the road, right? And so, but yeah. So I can definitely answer that. That's pretty much all I have. I'm gonna just put my slide up. You can of course follow me on Instagram, Pedro_Moore. If you haven't already, join the Facebook group. Please do. Black Acquisition Entrepreneurs. And of course, you can hit me up if you have any additional questions. But I'm open to any questions you guys have right now.
Hey, Pedro, this is Uche. Great presentation.
Thank you.
Lots of gems here. Um, it's more of a curiosity. So in situations where you're buying a say like a grocery store and the owner doesn't want to be involved going forward, uh, as an investor, you're now relying on say the store manager to now become this quote unquote CEO of the operation. Um, how do you navigate the issue of keeping them there, right? Because if he's the store manager, maybe he likes the previous owner, and now you're a new owner, and he doesn't have any equity stake in the business. But since you're not going to be there daily, you really rely on him heavily, to make sure that your profit projections happen. Like how do you tie or align your interests with the new store manager?
Great question. There's a little bit of risk. There's no guarantee because people can quit their jobs, right? So there's a couple things here, but the reality is too, no one just quits the job because the good part of the concept of living paycheck to paycheck, we know most people live paycheck to paycheck. So if they quit their job, one, they don't get unemployment. And if they quit the job, they're basically out of money, unless they have some other opportunity, they're kind of stuck with you. But don't get me wrong. That doesn't mean they won't start looking for another job down the road. But a couple of things could happen, depending on the type of business you go into. Small business like a grocery store are lower tier in terms of employees, so you may not have any employee agreements. But when you get to a little more sophisticated firms, there may be employee agreements in there that granted, it doesn't necessarily prevent someone from quitting, but it at least make you feel a little more comfortable that they're kind of in it for a period of time, that they will help grow the business. But really the main solution is building that rapport and trust and helping identify the culture great question, but actually, even though you're concerned, the employees are actually more scared than you are, because they're scared that you bought the business, you're going to lay everybody off and bring in new people. They're actually, I guarantee you, most of them are probably more fearful that you're going to do that than the new owner having them leave. But don't get me wrong, it still can happen. But that's when you go in and just kind of empower people and talk to them just to show that you're here. One, show that you're not trying to lay them off. That right there, if you can go in and show like, hey, yeah, you're not trying to change anything, especially if it's a good business, you don't want to change anything. The only time you probably would want to go in and start hacking people off if it's like a distressed deal, where the business is, but that's you have to have a little bit more of a skill set because you got to really know what you're doing. That's a situation when a business is really kind of bleeding in terms of profitability, and you got to go in and start cutting expenses right away to figure out how to stop bleeding to turn it around. But generally speaking, for good businesses that are generating a good profit, I'm gonna say 9 times out of 10, the staff there would like to remain there. And it is your job to kind of give that culture to say, hey, this is still a safe place. Yes, I did take over the business, but we're a safe place. And going in there, one, building that trust, but then also start putting a little more responsibility in your hands. Especially, let's just say that the shift manager or store manager, you want to elevate them. One way to get their confidence, if they're already at this level, you come in and say, actually, I do want to bump you up, give you a little more pay raise. Again, they still may stay even more because you actually put more money in their pocket, right? I know that was a long answer to your question, but I hope that helps.
Hey, Pedro, just to kind of go off of that last question, which I asked is, does it ever make sense, especially since you don't want to work in the day-to-day operations? I wouldn't either. Does it make sense to give one of the senior level employees some sort of stakeholder in the business, like small equity piece? Does that ever come into play, or is that like sort of the last thing you want to throw out there?
I would say that does come into play, but I would maybe give it last. I wouldn't just volunteer it because that's a piece of the pie. That's equity being taken away from you. But I would say first start off with, if there's opportunity for promotion to level them up. But then also too, what do employees really want in life? To be appreciated. We all been employees for the most part. What do employees really want? Just to be appreciated. So in addition to that, you can come in, for example, one idea is just coming in like, hey, what ideas do you have to help grow the business? Getting them involved. Small little things like that where you may not even have to give actual cash can help get their buy-in. But if I were to kind of rank it, I would say start off with getting their buy-in, getting their input of how to kind of grow the business where there's no money. And then minus the fact that you're promoting, because of course promotion does come with money. But then second is maybe give money. And then third is maybe equity. I hope that helps.
I had a follow-up.
Sure.
Are there any industries in the I guess under $10 million mark that you see are more open to being bought that has the ability to actually grow?
Yeah, that's a great question. I meant to share that earlier. So I will say industries that in general are growing, but the smaller enterprises are more fragmented. And so I'm trying to give you a good example. When I say fragment, there's a lot of different people. Excuse me. A lot of different people are doing it. So HVAC companies, right? There's a different HVAC company everywhere. Okay. However, if you were to buy a car company, of course, no one's suggesting that because there's a lot of big heavy hitters. There's only like really a handful of car companies that you can really choose from. So lean towards industries where there's a lot of it's really fragmented, meaning that there's a lot of people doing similar businesses. So if you think about it, whether it's maintenance, cleaning, contracting, even, I don't know if anyone has a tech background on the call, but even in IT services, right? What else? Trying to think of some more stuff, but basically industries were very fragmented, where there's not a lot of big giant players that are really capturing the whole market. And there's a lot of little players that are playing in that market, if that makes sense. So I would say go towards those markets because there's going to be a lot of people in those markets that will be open to selling.
Does area of the country play a part of your strategy? You only look for businesses locally in Pennsylvania, or would you look in other states?
I would say it would probably depend on what type of business you're buying and your understanding of it. I probably would prefer a rookie business if your first time, maybe doing something not too far away. When I say not too far away, I use a general rule of thumb in the angel investing world. Like most angel investors, when they invest in startups, they like to be a 2 hour radius from where they live. So I'll say that could be a good rule of thumb. But it really does depend on the business. It really doesn't have to be. I would say if you're in Delaware, Philly, you're buying a business in California and this is your first rodeo, that might not be the best, because for you to just pop in and check in, that may take some time. But I will say this. It does depend on the type of business that you are doing. If you're dealing with a really good, sophisticated business that has a lot of things in place, meaning that you have sophisticated people that have probably been there for quite a few years, that could be, you can probably entertain something like that that's really well put together. But I really would say it would depend on the business, because it really does depend on the business. But you can do anywhere. But if you're starting out, I would encourage, or I will recommend, or suggest rather, to start something two hours away from where you live. But after you get your first one done, you want to do maybe something else, I would say try to expand beyond that if possible, geographically.
Does anybody else have any questions?
This is Uche again. So two questions. One, if you could talk a little bit more about your deal sourcing strategy. I know you said that could be a separate class by itself, but
Sure.
But if you could give it, like, I guess you talk to brokers. I'm assuming you do mailers.
Oh,
that
I'm glad you said that about brokers.
Okay.
So yeah, I'll talk with that, but I'm glad you mentioned brokers. I don't like brokers. Here's the reason why. It's probably similar to what you guys experience when it comes to real estate investors. Brokers have one motive: to get the highest dollar, right? It doesn't allow for creativity in terms of doing a deal. Now, if you have the financial means, the financing already, that might be fine. But the brokers, they're going to try to. I'll give you one good example. There was a SolidWorks broker, a broker that was trying to sell some SolidWorks, and it was a fire sale, and the businesses weren't generating any profit. But brokers, they try to manipulate numbers to show like, hey, there's a little bit of a profit there. And they were still trying to sell it for 80 grand. I think there's two stores doing like, maybe $500,000 each. They're trying to sell it for 80 grand. Really, you shouldn't have bought it for anything, because the guy was, both the businesses were performing poorly. But the broker took it because he wants to get a transaction fee off of that. But if there was no broker in there, you could probably, especially if you know what you're doing, you could probably talk to the owner and like, hey, let me take this off your plate. They probably would just been appreciative of you taking the deal off their plate. They probably wouldn't have sold it to you for anything, or maybe something to maybe wipe off maybe a credit card balance or something like that. So I don't like broker because they take away creativity. But getting to the question about sourcing, I'll say definitely first starting off with what industry, some ideas industries that you would prefer to get in. And then, so whatever industry that is, start spending a little bit more time, I'm gonna just say, in those communities. I know it might be a little bit harder now because we're still in this pandemic, because what I'm referring to is networking. Because a lot of times if you have certain events, you just want to go in there and meet people, let them know, hey, like it's just small soft talk, right? Hey, yeah, I'm looking to get in this space, looking to acquire, a company in this particular category. It just start having conversations. So that's one way. But a marketing way is, so let's just say you do have your industry, and because of pandemic, you probably really can't get out there, but you can be more direct. And so one method is direct mail. Now this also depends on the type of business. More blue collar businesses can do direct mail, and direct mail, all that really is, I know it sounds odd, but it does work, is creating a basic letter, addressed to the owner of the company. Say, hey, I'm looking to, my name is so-and-so, I'm an investor, I'm looking to acquire a business in this industry. Just want to just ask, have you been thinking about exiting? If not, do you possibly know anyone that might be exiting? And just trying to create some kind of response, some kind of communication. More white collar, I'm gonna say white collar as like engineering firms and all that, you may be able to reach out to them via email that way. And it's just a constantly reaching out. I mean, you can go through to find deals, especially if you know what type of company you want to buy. If you go to Chamber of Commerce, right? You always have directory of businesses. So let's just say you go to Pennsylvania Chamber of Commerce and you want to buy a manufacturing company, right? You go in there, you go to find all the manufacturing companies, get as much information as possible, name, address, et cetera, et cetera. There are databases like Hoover, I'm drawing a blank of one of them right now, Hoover, and I think D&B or something like that. But these are ways to get additional information on some of these businesses. It'll help give you some insight on such as, sometimes it doesn't work, sometimes it doesn't, but give you like data such as who the CEO is, how much revenue they're doing, even without them giving it to you. And all you're doing is just trying to collect data, as much data as possible. So I say the first step is create your database of businesses you plan to attack, and then after that, it's figuring out a plan of attack, how to get to the owners after that. But creating a database, find industries, magazines, publications that might be listed, or you can go to certain chamber of commerces, or you can use the Hoover database to help find things. So it's really being creative, trying to find these companies. But those are just some general ideas of collecting names or businesses' names.
Thank you.
Oh, no problem. Any other questions? I know we have a lot of people on here. A lot of people are silent.
Yeah, probably because you answered most of their questions, or they probably.
Oh, okay.
Actually, I do have one quick follow-up.
Sure.
It just occurred to me. So is it safe to say then that you look to buy businesses that can just operate as is based on the numbers now versus, say, a turnaround type or value add type situation?
That's my personal strategy.
Okay.
It can be anybody's personal strategy, that's the beauty of it. If you, I'm not sure what you guys, can I ask you, what's your background?
Me?
Yes.
I'm a corporate banker.
Corporate banker. Okay.
Right.
And so, you probably, do you on the lending side, or what do you do mainly?
Yeah. Lending side, I'm actually on the other side of the LBO, equity sponsors.
Okay.
So the private equity side, I'm the debt side of that.
Okay. So the good part is you probably have a lot more deal flow than you really realize. You probably see a lot more, or you might know a lot more business owners on how to get to a lot of deal flow. And so I will say it'll come down to your comfort level. If you want to, there's nothing wrong with doing a turnaround, because if the turnaround works, you're going to really make a good amount of money off of it. But it may require a little bit more effort on your part that you might want to put in. So let's just say a lot of the deals. So I was asking because I was trying to figure out what your background is, to see if what your experience is, because sometimes for turnaround companies, if you have direct experience in that. So I'm just going to say, what if there's another small lending company that might be around, right? And because you know what to do, what they'll look at, and you might be able to go into that company and turn that company around because of your general knowledge. Not to say that you got to be an expert at it, but you have a lot of good working knowledge. Also, you have contacts in that industry too that can help you out. So a situation like that, you might be okay with going in and doing a turnaround, meaning that the company is really not profitable, not really doing great, but you can go in, fix it, turn around, and sell it or grow it to make it bigger because of your personal knowledge as well as your networks. Does that make sense?
Yeah, generally, yes.
Okay.
Right.
Now on the other side, it's more of, you could do the same thing on the side of where if you want to kind of build a business where you're more standoff and not doing the day to day. You can really do that with almost any industry, but in terms of personal comfort level, you can still lean toward an industry that you are familiar with. There's no harm in that, but just me personally, I like any industry. That's just me personally.
Hey, Pedro, I have a question.
Sure.
I might have missed it because I stepped out of the room a few times. When you're looking at buying a business, are you looking at a certain a certain percentage of a return on your investment, or are you looking for just a certain profit margin period off of a certain industry? Like, so when I'm buying a property, there is a return that I'm looking for, and that drives how I'm buying properties. Is that the same way here, or is it each deal is kind of different?
Each deal will be different, but still in the back of your mind, there is a potential to return that you would like. Especially to make it all, for example, generally was rule of thumb, the stock market is like 8-10% return. But when you're buying a business, you want something, especially you taking all this risk, you want something that's worthwhile. So it has to be at least 20%. And I prefer more on the cash on cash return of how you get your money back from the capital that you actually invested. But I would say at the very least, a cash on cash return of at least 20%. Because you're taking on more risk than investing in the stock market.
Gotcha.
Mm-hmm.
See if there's any more
But another way to look at it too, I mean, you do want to look at it as percentage, but you can't look at it as how can this give you a particular lifestyle, right? If using that, since we use that grocery store as an example, if it's netting $100,000 a year, that can kind of help you, let you know, like, okay, I can pull maybe 20, 30 grand as a management fee every year off of this, which can pay for a particular lifestyle. Maybe it just pays for the cars for the household or whatever the case may be. So that's just another perspective to look at it.
One thing we did, I don't think you talked about here, is sort of deal structuring on the buy side. Because I'm assuming if you're buying multiple businesses, you're not buying them by yourself.
Yeah.
You don't have to go into and deep dive into it. But can you just go over just a couple of general structures of ways that you may buy these companies?
Yeah, well, first thing too, you just brought something to my memory. One good thing, most your lawyers will probably tell you this anyway, but when you do buy a business, you will actually do an asset sale agreement, and all that really means is that you're just buying even though you're going through the whole process of buying the business, you're not technically buying, because there are scenarios, especially when a turnaround business, you may just be buying the assets of the business and getting rid of everything else. But still, even in buying a good profitable business, you're coming down and doing an asset sale agreement where you create your own LLC for that business, and then the seller will have to kind of dissolve their LLC, and then your LLC now assumes the new business. And part of the reason why, because you don't know what taxes they, if there's some kind of legal liability, that might be to the brand, because and the thing is, a situation could have happened maybe 2 or 3 years prior, and they never acted. But then, as soon as you take over, there may be some kind of litigation that might start it that happened 2 or 3 years ago, and because even though your branding is still the same, but the actual corporate entity is different, so that kind of helps cover that up, not cover that up, but helps remove that potential risk. And actually, after answering that, what was your question again? Because I just wanted to highlight that first. What was your question again?
It was more about deal structure and like if you want to buy multiple companies, same way as if you're going to buy multiple properties,
How to do it?
At some point, you're not going to be doing it by yourself. Can you talk about different structures, maybe like partnerships, and ways to finance the deals?
Yeah, absolutely. So I'm going back to some of these options too, where all these are ways to kind of structure a deal, and these are just general ideas. Of course, obviously, cash, but equity investors, same thing that you guys kind of go through. So in that grocery store scenario, if you're trying to structure a deal, and sometimes this is also good too, because you can find investors, especially if you have a hard asset that's actually performing well, and you want an investor to kind of come in, you can give that investor, maybe there'll be like a silent partner in that scenario, equity stake, 10-20%, depending on how much they wanted to invest in the company, and that can help you. That's part of your capital stack to help finance that particular deal. Also, as I mentioned earlier, the owner rollover, equity rollover, and that's a scenario where, if let's just say the company, he wants to sell a company for $1 million. Let's just say that you have majority of the money, but you don't have 200 grand. So you can structure a deal where to say, look, how about we, we got majority of 800 grand available for the business, but we still don't have the 200K. But what if we give you 20% of for the seller? We'll even though we're taking a majority ownership, but we'll leave 20% for you to keep. And so that means when you guys are doing distribution to yourself, obviously they get 80% of that pie, right? And also when you build and grow the business, if you just decide to sell it, if you don't buy them out before then, you get to they get 20% of that cut too. So those are just some scenarios of structuring various deals, because you're right, if you're trying to buy multiple deals, you got to figure out various ways to how to get that deal done. But yeah, it definitely does help too if you start building relationships similar to the real estate world of private investors that you can that have some deep pockets that you can leverage on occasion for particular deals to help fill various voids and closing the deal.
Got it. All right, it's getting a little late, so we'll get ready to wrap this up. Thank you, Pedro, very much for that great information. It's just again just another asset class, another tool, and in another tool in your financial tool belt. Thanks again, man. And it sounds like you really have a lot more information. So we may have to even do like a weekend class if you would be up to it.
Yeah, absolutely.
Dive deep into this. Just to let everybody know that there will not be an August brag meeting. We will be back after that. Thanks, Stephanie, for setting all this up and all of the speakers for the future. And everybody be safe out there. And I think that's about it. Unless there's anything else.
And thank you guys again for having me. I'm hoping this was helpful to at least start having everyone to start thinking about this as a asset class to participate in. And I hope this at least whets everybody's appetite a little bit.
Become sophisticated. That's what I tell everybody all the time. Become sophisticated. If you want to make it in this country anyway, you have to be sophisticated. You have to really not be so rigid when it comes to you not just, I'm just real estate. You have to understand business because at some point you want to take that money off the table and maybe put it somewhere else. So if there's ever a time like we had in 2008 and prices fall, well, fine. I don't have all my money into properties. I have some of my money into business. I have some of my money into stocks. I have some of my money into precious metals. So it's not all in one place. So I think it's great that we have these conversations.
And if I can add to referencing, you mentioned structuring deals, and I'm sorry, sir. I forgot your name. The gentleman that with the hat and the glasses that worked in Linden.
Oh, Uche.
Uche, yes, Uche. Part of the reason why I'm also doing this to whet everybody's appetite to also create deal flow too, because one thing is that as now that everybody's thinking about like, hey, it is possible for me to buy a business. Everyone is going to start having that in the forefront of their mind, because I believe that as we all start thinking, have it in a forefront. It's like you ever come across a situation where either you buy a car or your friend buys a certain car and all of a sudden you see that car everywhere. It's kind of like that mentality where now that it's in everyone's mind, like, oh, okay, maybe I can do that. So now everybody's going to start thinking, and the more deal flow, because I'm big on sharing deal flow, because Dan talked about deal structuring. I think that as a community, as we start sharing more deal flow, shared knowledge, other people would like to be invest. Not everybody, but some may, right? And I think the more and more we share deal flow with each other, because even in that community that I'm having, I want to start doing that just to let people know. And that's another reason why I want to ask people where their background is, because
that might be important when it comes time to acquire a company. Because let's just say, you know, I came across a maintenance company, but I don't have any background in maintenance. And so, but I know so-and-so that has a background in maintenance. So I might bring that person on to kind of help facilitate that, or help with that particular deal, right? So, but I think it just comes down to just community, always. So if you ever come across the deal or you hear something, share it. And so that way we can also have a conversation around it, see how we can attack it.
Well, I certainly look forward to connecting with you guys. So
Yes. I enjoyed your questions too. Thank you.
And all become wealthy, hopefully, right?
Yeah, that's the goal, right?
no, it has to happen. So it's not even hopefully.
Yeah, it kind of has to happen, right? It has to happen.
All right, everybody. So if that's it, we're gonna wrap it up. Everybody have a good night. Be safe, and we'll
All right,
talk soon.
Thanks,
Thank you.
Pedro. Good night.
Thank you, Evan.
Thanks, man.
Thanks, guys.
Take it easy.
See you.
All right, everybody.